Hey, friend, welcome back to the Live Off Rent Show, where we bring in real estate and other financial experts to help you build passive income, build wealth, create your dream lifestyle, reach financial independence, all those things that we all want and dream about. As always, I'm your host, Brian Davis, co founder of Spark Rental, and I'm on this journey with you. Every month, we sit down with different passive real estate investments and sponsors and syndicators in our co-investing club. We grow them, we vet deals together, and I'm in the trenches investing my money alongside all of our members. So without further ado, I am excited to introduce our guest today. Gino Barbaro is an investor, business owner, educator, entrepreneur, and podcast host on 4 different podcast shows, if you can believe it. As an entrepreneur, he has grown his real estate portfolio to over 2,200 multifamily units transacted and over 350 million in assets under management. So, Gino, welcome to the show.
Brian, thank you for having me on. How you doing, brother?
I'm doing great. I am pumped to be here and have this conversation with you today. So, one place we love to start with all of our guests is just how you got into real estate in the first place, and then from there we can talk about your journey and what's changed over the years.
Brian, I got into real estate, I think, a couple of different ways. I like to call it life before Jake and life after Jake. Life before Jake for me was I had a restaurant. That was my first career change out of college. Got into the restaurant business, loved it, was with the family. '07 comes along, my father passes away, and I ask him, I live in his dream or I live in my dream? And I loved working with my dad. And at that point, the Great Recession came along, and I didn't want to be at the restaurant anymore. And I knew that the real estate, I had a passion for it. I liked it. I had done a couple of really good deals, but I'd done a couple of really bad deals. And when I met Jake in 2009, he was a pharmaceutical rep, taking orders out of the restaurant and bringing them to doctors' offices and selling pharmaceuticals.
Interesting.
And I loved his work ethic. I loved his make it happen. I loved his values. In 2011, he moved to Knoxville, and that's when our journey started. It took us 18 months, me and Jake, to find our very first deal. A little bit longer than we expected, but hey, better late than never. No deal is better than a bad deal. And we passed on a lot of those. And after that, 3 months later, we found our second deal. 6 months after that, we got our third deal. And, within the next 5 years, we had probably gotten around 1,000 units. So that's how it started. It started with me meeting Jake at the restaurant and finding out that we both wanted multifamily. And Brian, let me finish with this note. I had made the mistake of the shiny object syndrome, jumping from my mobile home park in '05 to my strip mall in '07 to my duplexes in '08. I finally planted my flag in multifamily and said, if I'm going to be serious in this business and I want to build a real business, let me learn a niche really well. Let me suck it up. And I went out, I invested in mentorships. I learned multifamily. So then when the opportunity called Jake presented itself, I knew what I was doing. And Jake was the opportunity that moved into an amazing market. He was boots on the ground, and I was more or less the person driving the ship for those first few deals.
It's a recurring theme on this show with all the guests that we bring on, or almost every guest we bring on, that they had the humility to go out and get an expert mentor at a certain point in their career arc, someone who had already succeeded doing what they wanted to do, and then we're able to skip a lot of the pitfalls and headaches. And it's a theme that I come back to pretty often because I did not do that in my 20s when I went out and started buying a bunch of single family rental properties. And I made so many expensive mistakes that in hindsight, I just want to do the face palm and be like, what was I thinking? But you can avoid those
Yes.
mistakes by getting a mentor or coach or senior partner or somebody who has walks the path that you want to walk and is a few steps further ahead than you are. So anyway, just wanted to highlight that. And I love what you said about finding a niche and really committing to it and doubling down and becoming an expert within that niche and really mastering that niche. It's a cliche to say, but there is some truth to that saying that the riches are in the niches. You really want to become an expert in one style of investing and really master that. And then, you can keep produce that becomes a cash cow for you, right? Like you can keep executing on that again and again once you've built the expertise. So tell us, so you did your first multifamily deal with Jake. And how did you scale from there? I mean, how did that first deal go? How did you structure it? How did you start scaling? I mean, if anyone here is interested in getting into multifamily, whether on the small side or on the larger side, and maybe syndicating, what would you tell them?
Well, the mistake that I made before I met Jake is I had no process. I had no map. Honestly, I had no system. When I met Jake, that first deal was a mom and pop. And we had realized what we had done properly on that very first deal. And we started creating what we call the buy right, the manage right, and the finance right framework. It really was, I don't want to say that simple, but when it dawned on me, I'm like, wow, picture a wheelbarrow with the two back legs. You have the buy right, which is one back leg, and the finance right, which is another back leg. And then you have the wheel of the wheelbarrow, which is in constant motion. That's the manage right. Now, you had mentioned something earlier on before we hit record button. Well, mistakes 2 years ago. Finance right, short-term interest, bridge debt. Well, if that finance right leg ain't right, guess what happens? And what about the buy right? If you're buying really expensive properties and you don't know how to buy, you don't have a buy right criteria, what happens? That leg falls. And operations is really important, systems and scaling. So the framework has allowed us to really dial in what we're buying. We like longer term fixed rate financing. We've been screaming from the top of our lungs for years. And listen, it's been challenging for the last couple of years. Back in
No
21 and
question.
22, we passed on a lot of deals. We probably had a combined 150 units in those 2 years, but we were doing other things. We were working on operations. And when 2023 came, last year, we did over 350 units. So it's one of those things where we could have gone out into the RV space, but if we want to become the Chick-fil-A of apartments and deliver superior customer service and be vertically integrated, let's not get that shiny object of RV parks and let's focus. Now, to say that that's what we want to do. As you're listening to this, what are your goals? What are you trying to accomplish? Not everyone wants to do what Jake and Gino wants to do. If you want to get into syndication or get into other avenues, learn one niche, and then once you're pretty well established in that, then say, hey, let me go look at RV parks. But it's very hard to run a multifamily business full-time with a full-time property management company and then slide into, RV parks, which is a completely different model. Now, if I have partners and I'm partnering with people who can operate it, that's a different story. But we have our own capital. We're doing our own deals. So why would we go into another lane when we're doing so well in this one? And it may be boring, but last time I checked, most of the people on this planet who have created true wealth and have created true legacies, they've done it the boring way. They've showed up to work, they've put their hat on, they've done the job, and they let their money work and compound. And it's no different in real estate. The reason why you lost your money and the why I lost my money early on was because we had a different idea. We didn't run them as businesses. We saw them as investments, buy high and sell higher. We weren't building systems and processes and looking at it from an entrepreneurial lens. Once you start looking at it that way, whether you're a limited partner investing passively or you're doing it actively, to me, everything changes when you start looking at it from that perspective.
Yeah, I'm really big on investing boring because investments, it's not a hobby. It's not supposed to be exciting. It's supposed to help you build wealth, right?
Yes.
It should not be something that you do for kicks, right? It's not something that you do so that you can have a story to tell at cocktail parties. I mean,
Well, Brian, that's what people do. And let me interject really quick. I'm sorry to cut you off, but I've got my phone here right now. And I got into crypto about 2 years ago, just as a joke. Invested a total of $50,000. That's where the portfolio is. But as I noticed, it's very hard to invest and create wealth in stocks or crypto long term unless you're creating some type of dividend yield, right? Because you're in there, the euphoria, the emotions, you see it go up. I'm up 42%. Let me hit the exit button. Great. You gain 42%. You've got to pay taxes on that money. You've got to put that money somewhere else. You're buying something else at a high point. Meanwhile, that 42% could have turned into 3,000%. That's the issue with investing in these alternative assets. Whereas when you're investing in a multifamily property, you've got a longer term time frame. You need 6 to 12 months to reposition this asset. You're getting these amazing tax benefits. You're getting this, hopefully, you're getting a cash flow, a dividend yield every month. Your principal is getting paid down. It tends itself to longer term, and you can't hit the exit button. I mean, why would you on a great deal? You just refinance the deal, recrystallize that equity. It's a loan to yourself. You're not paying taxes on that money, and you're going and putting that money into the next deal.
Infinite
That's
returns.
really
Yeah.
that's really how you create wealth in multifamily and in real estate. It's a lot harder to do in those other avenues. Although, like you said, when I'm showing up at parties and you're like, "Hey, bro, I bought XRP at 30 cents. I sold it at 72. I made 105%." That's much more sexy than telling somebody, "Yeah, I'm making $250 profit per unit on a deal," and it doesn't sound as alluring. But I promise you, the second scenario will make you wealthy. It will create generational wealth for you.
Yeah. Well, so crypto is so funny, and I don't want to go down a crypto rabbit hole. I have a little bit of money in crypto purely for fun and as a
Yes.
speculation. But that's the thing that I feel like not enough people appreciate about crypto is that it is speculative inherently because while it probably does have some inherent value, it's impossible to know what that inherent value is. And
Hmm.
therefore, it is by definition speculative, right? Like,
Yes.
I mean, a company that generates revenue has something you can measure, right? It has inherent value. A multifamily property that generates revenue has inherent value because it generates revenue, and you can measure it and you can look at it. Uh, Crypto doesn't generate revenue, and again, yeah, there's probably some inherent value there, but no one could tell you exactly what that is. So anyway, I don't mean to go down the rabbit
No,
hole of
but
crypto.
Brian, you made a great point. If you look at it from the real estate perspective, fixing and flipping a home is very similar to crypto. I mean, in real estate, you do make a lot of money on the equity. That's where you make the majority of your profit. Even in a multifamily, you're making cash flow every month. But what you're trying to do is you're trying to crystallize that equity through an exit, which is either a sale or a refinance. We've been able to refinance over $25 million and put it into our next deal. Now, crypto is very similar. You buy it for $1, you sell it for $2. You're flipping a home, buying it for 100,000, selling it for 200,000. It's sort of the same process. Although in real estate, you got to be careful. There's market cycles. You may get caught. You need to understand what type of strategy and what your exit strategy looks like. The thing I like about with real estate, it's a hard asset. It's a basic human need. That's the thing that I always lean back on. There's something called cycle resiliency. When the market does soften and there is a recession, hey, renting is cheaper than buying a home. People need a place to live. And we're not there yet with crypto. I think there's, as far as the technology, it's going to be useful, utilized with blockchain and all. I just don't think that people understand the difference between buying something speculative for just equity and then buying something for equity and cash flow.
Right. And the other difference with real estate is that it has a demonstrable market value. Now,
Yes.
to your point, the market value can change a little bit, but real estate values change relatively slowly compared to stocks or crypto. Uh,
Yes.
and you control the forced equity, right? When you flip a house, you add value to it by improving the property. So
Hmm.
you control a lot more of that, and it's much more predictable. Anyway, don't want to go down too much of a rabbit hole there. So I'm curious. We touched briefly on financing risk, and but before we hit the record button, you and I were talking about how 2 years ago, not nearly enough real estate investors, and in particular real estate syndicators, not nearly enough of them were talking about interest rate risk, right? And then a lot of people got burned over the last 2 years because of that. They were taking out short-term debt with variable interest rates in some cases, uh, and they got burned. They not enough people were aware of that risk 2 years ago. And then we were also talking about how 1 year ago, not enough people were talking about insurance premium risk, or about the cost of labor going up also faster than rents, than incomes or revenues for these properties. So I'm curious to hear your thoughts on what are the risks that we're missing today, right? Like what are some of the risks that not enough people are talking about in the real estate space today?
Well, I really haven't heard anybody, correct me if I'm wrong, about a possible depression coming or a possible crash of the economy. I mean, if that does happen, I mean, there's rent growth. There's going to be negative rent growth. I mean, that's the reality. I mean, values are going to come. All of a sudden, there is a lot of money on the sidelines, so the money will come in. But there's a scenario where, I mean, have you heard anyone ever talk about a depression? It could occur. It could happen. And if that does happen, multifamily really, the values come from future cash flows. If rents are going down and all of a sudden occupancy is going down and your net operating income is going down, your values are going to go down. And I think the other thing that I want people to be wary of, you need to be buying assets on the current market cycle based on today's interest rates. Don't buy a deal saying to yourself, yeah, this is barely working. I'm losing money, but in 18 months or 6 months, I'm going to be able to refinance it out at 4.5 and I'm going to crush it then. That is very risky because there's two ways that you lose money in real estate. You either run out of time, like the short termers did it, or you run out of capital. And I think running out of capital is another thing we need to be aware of. You need to make sure that in your CapEx budgets, you have enough money allocated on the side to make future improvements. Right now, people are holding their noses in buying older assets in multifamily because they've been burned. They see that the banks are coming in going, we want a 60 to 65% loan to value. And oh, by the way, you need to make $3 million in these repairs. And you're like, whoa, where did that come from? Debt is the circulatory engine of the economy. Debt has been pulling back. They've been smart this part of the cycle. They're pulling back. Loan to values have been dropping. They want more reserves. They want these properties to be fixed up. So if you're going to be buying an older asset and holding it for the longer term, and that's what your exit strategy is, make sure that you have enough reserves set aside that you can actually satisfy the property. And if you're a sponsor or a syndicator out there and you're doing these deals and you're taking acquisition fees and you're collecting those fees, but you're not giving out any distributions or dividends or yields, for the foreseeable future, you're holding off. You may want to hold off on taking those fees or doing something with those fees because there's a little risk in there as well, because you're getting paid well in advance of what your investors are getting paid for. And that's something that I don't know people have really understood. The last market cycle, you did a deal, property cash flow. This one's a little bit more challenging. You have to put a little bit more work and effort, and it takes a little bit more time. Now, is it illegal to do the money? Absolutely not. But just understand that it may not seem fair to an investor by saying, oh, Gino just got a fat $500,000 AC fee, and I ain't seeing money for the next 18 months. That doesn't seem great. So just be careful as you're doing that, because I've seen a lot of investors, all of a sudden, they've got capital calls, they've got things going on. They've already paid a lot of these fees, and now they feel as if they've been burned. So just be careful, all of you out there going forward. Keep that in the back of your mind. Say, should I get paid or should I put that money aside? And when the property starts performing, maybe I can take the draw.
Yeah, well, it's a great point about it creates a misalignment of interests when the sponsor is getting paid up front, yes, but they haven't actually delivered any returns for their investors yet. They're not actually planning on paying distributions in the immediate future. So yeah, no, that's a great point. And it's funny you brought up the risk of recession. Back at the end of 2022, it was a major global bank, and I can't remember which one, but their head economist made big splashy headlines by announcing a 100% risk of recession in 2023, which of course didn't happen, right? It absolutely did not happen. And then people got so kind of cynical about that they just wrote off all recession risk entirely. And by the end of 2023, the prevailing mood was there's a 0% recession risk going into the next year, into 2024, right? But that's not fair either, right? I mean, that's not right either. I mean, in any given moment, there's less than a 100% chance, but definitely more than a 0% chance of a recession happening, something unforeseen, hitting the economy that no one happened to see. So yeah, the recession risk is very real, even though no one is pricing in a recession risk right now, not with stocks, not with real estate.
No, and Brian, what about the debt to households? I mean, like I have renters paying. I mean, I keep hearing they have enough for a month's month's salary. I mean, there's definite risk in that, and I call it the silent recession. I don't care what anybody says. I've been in business long enough to understand that things really are stagnant right now. It feels like there's stagflation. I mean, prices keep going up. They can't lower interest rates because if they do, they'll create a boom because there's not enough supply of real estate. So there'll be a lot of demand. So they'll create the boom. Prices will go up again. The middle class is getting squeezed. So I don't even know how they define a recession anymore. All I know is a recession is if my neighbor loses a job. A depression is if I lose a job. So that's the interesting thing. To me, it feels as if these last 18 months, we've been in this type of silent, slow, grinding, get in the way, and it doesn't feel like growth to me. And it feels as if these jobs that we've been adding were just jobs that were lost over the last 2 or 3 years. And what happens when AI comes along and people start to figure out, I can get rid of Brian and Gino because we don't need them. We can have AI start working. What happens when that scenario takes hold? We're not looking at all of the risks And I think I don't want to scare anybody, but that's the reality. If you're talking about inherent risk, there is risk in that. And I think if the market and the economy does really slow down, it will affect real estate. I'm looking for it to, because I want these prices to reset a little bit more. I still think prices in multifamily, they're still a little bit high. We've seen them come down. They've been down like 13% since 2022. They still need to come down a little bit more. And I'm not, it's a really terrible thing to think of, oh, I want a recession to occur, but we need some type of resetting of a lot of these asset prices.
Yeah, and you're certainly not the only person I've heard say that. That makes sense. And one other risk associated with recessions that I want to touch on, that you kind of alluded to. So in a recession, you have rent default rates rise, right? You have occupancy rates fall, so vacancy rates rise. And historically, in a recession, some homeowners lose their homes to foreclosures and become renters, which cause pain in the home sale side of the market, but it keeps
Yes.
rental markets more stable. But there was so much foreclosure pain in the Great Recession, or really in the aftermath of the Great Recession. There was a huge wave of foreclosures from 2008 through like 2011, really. I mean, and into 2012. I mean, it took 3 or 4 years for that foreclosure wave to move through the system. And there was so much pain around it that this over the last few years, and in the COVID pandemic in particular, there was so much fear on the part of the government that would happen again, that so they introduced foreclosure moratoriums and eviction moratoriums. So I actually think that adds more risk to the residential investing side of real estate markets, because you won't have those people leaving homeownership to become renters to kind of prop up the rental market in a recession,
Mm-hmm.
and stabilize some of the downward forces, like the higher default rates and the higher vacancy rates. So I actually think that adds more risk in multifamily than people have really given much thought to. Anyway, just
Mm-hmm.
I'm curious to hear your thoughts on that kind of hypothesis of mine.
It's a good hypothesis. I like it. I just think that there's a supply and demand imbalance. I think multifamily right now in certain markets, you have to be wary because there's been a lot of completions of multifamilies, really
Definitely.
big in 2023. But that's really the higher end. I'm working the B minus C plus space, so it doesn't affect me as much. There may be a little bit of trickle down, but in markets where I'm at, there hasn't been a huge influx. Now, if you're in Nashville, if you're in Phoenix, if you're in some of these markets that there's been this tremendous supply, on the flip side, there has been a lot of population growth in those markets. So they have had a lot of the absorption going on. That's why I'm saying if there's a big recession and you're still trying to absorb those units, that's where the risk comes into play. So you need to be aware of that. But it's really been a funky market, to be completely honest with you, because the supply, it's nothing like '08. I think the banks are much healthier than they were in '08.
They are.
I think the equity in homes is a lot more. I think, what is it, 50 or 60% of the population has an interest rate of, 3% or less. I think almost 50% of the homes in the US don't have a mortgage to begin with. So I think there's a lot of more equity in the homes. And you're seeing that when a home goes on the market right now, there's not a lot of supply. There really isn't a lot of supply. So I think there's a different kind of risk. But for multifamily, just be wary of what market you're in. Make sure that if you're in a market that's losing population and losing jobs, that's the risk, because you're trying to sell space and it's about supply and demand. If there's less demand for your apartments, you're going to have to drop rents.
Yeah, and so during the pandemic, there was a lot of migration that happened, right? And especially interstate migration. A lot of people moved out of major cities and they went to, either resorty kind of areas or mountain areas or Sunbelt cities, but then that slowed down. And but because of what you were talking about, the absorption of all the building that's gone on in some of those cities, that population, that moving trends, those have largely stopped, and in some cases even reversed. But it takes a couple years to build a multifamily
Mhm.
property. So now you have all of those apartment buildings hitting those markets that were like pandemic darling markets. But now I mean, they're not seeing that sustained population growth anymore. So
Hmm.
anyway,
I can say in St. Augustine, where I live in Florida, the market's changed here forever. I think Florida may be a little different because you have the people in the Northeast. Now it's getting more expensive. That's the problem. So the migration may slow down. But St. Augustine 7 or 8 years ago was actually a rather affordable place to live. And now with the pandemic and with just the quality of living, the location to the beach, the city, that's changed forever. And people who used to live here, they can't afford to live here anymore. But there are certain markets, like if you're moving to Kansas City because you thought you were getting a great deal and you were living in California, well, you're like, I don't want to be in the middle of the country. I just left the beach to go to the middle of the country. I can afford to go back. And I think you're right. There are a lot of people that are hopping back. So that is a risk.
well, I want to be sensitive to your time here, but tell us a little bit about what you guys are doing and how people can learn from you if they want to get into multifamily investing.
Well, Jake and I, we run a vertically integrated real estate company. We manage our properties. We've got 1,600 units in the portfolio currently. We just exited our third and final syndication. So we've done every facet of the business. I just told you we're closing on a 4 unit next week. Now, why would a person who owns 1,600 units buy a 4 unit? Because it's going to net us $500 a month in profit per unit. And it's right next to our 12 unit. When we go to refinance it, we'll refinance the money out. It's 3 bedrooms, quality construction, amazing median income. These are the things that we're looking for. And what we've been doing over the last 10 years, Jake and I, we've launched a couple of books. We're teaching people. And selfishly, as you create a community, you learn just as much, probably more from the community than what you teach in the community. And that's what I love.
Absolutely.
That's why we created Jake and Gino. We created it because we wanted to become really good investors. We wanted to really understand how to buy right, how to manage right, and how to finance right. And then from there, teaching that model to the community and then getting feedback, tweaking the model. And, for instance, who knew credit unions were an amazing place to go buy multifamily properties and finance multifamily properties? A student told us 18 months ago, hey, we're using credit unions. Great. Guess what we did? On our deal we closed in December, we used a credit union. Probably wouldn't have done that unless we were locked in to the community that we created. So for those of you out there looking to get started in multifamily, don't do what I did. Don't try to go it alone. There's just too many resources. There's a ton of education out there. The key difference with any mentorship group or any community is the implementation. It's all great. Hey, I know I've read all this stuff, but what do I do next? That's the question. What's next? And when you find the right mentor, program, community, they will show you or tell you or let you know what's next. That's the important question is, I've done this. What's the next step?
Well, there's so many things that I love about all of that. Yeah, I mean, community it's the missing component for so many people. I mean, I love books and listening to self-help books or self-development books, personal development books. But education is only a small part of the where the magic happens, right? I mean, you need the consistent support from other people and people holding you accountable and saying, to your point,
Yes.
what's the next step? How do you transform this knowledge that you just learned into action? So having communities that are action oriented makes all the difference in the world. So anyway, I love that. And I love that you guys are investing in smaller properties as well, not just the big 200-unit properties, but it does make sense to buy a 4 unit if you have a 12 unit right next door. That is a form of scaling, right? So
Yes.
yeah, people get caught up in the numbers sometimes, but it's not just about the numbers. It's about a strategy that makes sense holistically. So anyway, Gino, where can people connect with you if they want to join your community?
Just go to jakeandgino.com. We've got the podcasts on there. We've got the blogs. We've got the books. We've got a ton of resources there. I mean, if you're in the single family space and you're buying small multifamilies or you're trying to scale the portfolio, listen, our students have closed over 75,000 units. They've raised over $500 million. It takes a while to get going. I mean, the first couple of years, the community was just getting its feet, under itself, as we like to say. But we've had some amazing success stories, and I think it all ends to what you said, Brian. It comes down to the accountability and to the fact that, hey, if I pick up a phone and I talk to my coach, I know what to do after the LOI is in. I know what to do during inspection. I wish I had that early on. I wish I had the ability to call somebody early on. And that's why I started the community. When I did get that mentorship and I was able to pick up the phone and ask those questions that I didn't know, that changed the trajectory of my investing as well.
Well, I love that. Gino, thank you so much for coming on today. It was a great conversation. We hope to have you back soon.
Thanks, Brian.
And guys, if you enjoy these conversations that we have, please rate, review the show. It means the world to us. And we will catch you next week, same time, same place. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.